Hi, good afternoon. Welcome to the next lesson in the Basic Income Tax course. This will be class 3. We're working with deductions. Lesson 7, we're going to be covering itemized deductions tonight. So welcome. This is the basic series. This is the last course in the basic series where we went through the basics and some income and deductions. We'll be starting the intermediate series soon, as well as handling certain portions as individual topics. So for lesson 7, we're going to be covering itemized deductions. We'll be working with specifically medical and dental, taxes that you pay, interest you paid, gifts to charity, and a few other miscellaneous deductions. The important part of tonight is to be able to understand how you would calculate your itemized deduction so that you can compare it to your standard deduction, which was covered in lesson 6, and determine which is the most advantageous for you in any given year. We want to understand the deductible portion of medical and dental expenses and learn about how you can deduct certain taxes that you paid and determine which interest payments are also deductible. We're going to also work with charitable contributions as well as a few miscellaneous deductions. We'll also cover the limit on itemized deductions. Once you reach a certain income level, you begin to phase out of your ability to use the itemized deductions. Okay, if the total amount of your itemized deductions is higher than your standard deduction, you will probably want to itemize. This would reduce your AGI and actually lower your tax liability. You're going to report your itemized deductions on the Schedule A. The amount will be on line 29 of the Schedule A, and we're going to enter that on line 40 of the 1040, the same place that you would put your standard deduction if you were using a standard deduction. So here's an example. We have Tommy and Pamela. They're married, but they've lived apart the last 2 years. Tommy's return will be married filing separately, and Pamela will claim their 2 children and file as head of household. She's going to itemize her deductions. Because she is itemizing her deductions, Tommy cannot claim the standard deduction, and he must itemize his deductions even if he didn't have any deductions, or it would be less than the standard deduction for him. However, if Tommy itemizes his deductions on his married filing separate return, Pamela will still have a choice because she is filing as head of household. So head of household does not have a restriction, but married filing separately does have a restriction. So even though you have a couple, each filing with separate filing statuses, only the one with the married filing separately filing status is limited in taking the standard or the itemized deduction based on what the other spouse is doing. Itemized deductions, we can use medical and dental expenses, taxes that are paid, certain interest payments, as well as gifts to charity. There is the ability to use casualty and theft losses, as well as job expenses and other certain miscellaneous deductions. This is actually all pulled together on the Schedule A, and the Schedule A is the form for itemized deductions. And you can see here the sections that we were just covering on the last form, where you have your medical and dental expenses, as well as the taxes that you paid, any interest that you paid, gifts to charity, casualty and theft losses, job expenses, other miscellaneous deductions, and then you'll total it all up here on line 29, and then that'll be carried over to line 40 on the 1040. So your medical and dental expenses, you can include any medical expenses that you pay for yourself and for your spouse or any dependent children that you claimed on your return. A person who was your dependent at the time that you paid the expenses or at the time that the medical service was provided. And any person that you could have claimed as a dependent, except that that person received $3,950 or more of gross income, or they filed a joint return. Medical and dental expenses must exceed 10% of your AGI before they are deductible, and that is 7.5% if you or your spouse was born before January 2nd of 1950. That 7.5% used to be standard for everyone. It was moved to 10% with the Affordable Care Act being implemented. And here it does say you might want to determine what 10% of your AGI would be before you go through adding all of your expenses, just to see if your medical expenses are likely to exceed this amount. This is something that I tell people, look and see. There's not a lot of point in adding up a whole lot of $20 if you're looking at 10% of your income being $4,000 and you know that you didn't go to the doctor 200 times. So here we have Chico. Chico is 49 and his adjusted gross income is 25,000. 10% would be 2,500. He paid medical and dental expenses of $3,000. So he's going to put those on his Schedule A. He'll have $500 as a deductible medical and dental expense amount on his Schedule A. So if his medical and dental expenses had been $1,500, would he have any medical deductions on Schedule A? And the answer there is no, because since he had $2,500 as his 10% of his AGI, it would have to be an amount over the $2,500 before it even begins to count towards his itemized deduction total. Here we have, and this is right out of publication 17, so you can go there and pull it down yourself, the medical and dental expenses that you can include and those that you cannot include when calculating your medical expenses for your deductions. Medical transportation is also something that is deductible. Transportation expenses must be incurred primarily for and essential to medical care. You can either use a standard rate, which in 2014 was 23.5 cents per mile, or you can use your actual out-of-pocket expenses. And you are allowed to look at which is going to be most advantageous and choose the amount that works best for you. So here we have an example. Greg drove 1,000 miles for medical reasons in 2014. He used his car. His actual expenses associated with that 1,000 miles was a total of $370 for gas, $10 for oil, and about $20 for tolls and parking. So the question is, should he use his actual expenses or a standard deduction for calculating his transportation expenses? So looking at the math, if he used the standard deduction mileage rate, his expense would be $235, which would be equal to 1,000 miles times 23.5 cents per mile. So he'll use $400, which is the $380, the $370 for gas, plus the $10 for oil, plus the $20 for tolls and parking for his car expenses, along with his other medical expenses, because the $400 is more than the $255. So he figures the standard mileage rate and he can claim the $20 of tolls and parking regardless of which method he chooses. That $20 of tolls and parking goes into both calculations. Medical lodging. You are allowed to use medical lodging as an additional medical expense. The lodging must be primarily an essential for medical care. The medical care must be provided by a doctor in a medical care facility, and the lodging cannot be extravagant. There can be no significant element of personal pleasure, recreation, or vacation in the travel away from the home. So you can't go by and see a doctor who specializes in arthritis while you are down at Disney for a family vacation and then write off your medical lodging. The lodging expense is limited to no more than $50 per night per person. There is the ability to write off cost of living in a retirement or nursing home as a deductible for yourself and your spouse or any other dependent if they're there because of the availability of medical care. So if they happen to be in a rehab center, retirement, or nursing home, or even an assisted living facility, if the primary reason why that location was chosen was because of the availability of medical care that they take advantage of, then you would be able to use that as a medical deduction. In addition, any home improvements that are not increasing the value of your home but are required for medical conditions are also deductible. So if you needed to upgrade a bathroom to meet the needs of a handicapped person living in your home, whether they're spouse, yourself, or a dependent, or if you needed to do any other type of renovations, including maybe a handicap ramp or anything like that, as long as it doesn't increase the value of the home, you would be able to write that amount off as a medical deduction. Insurance premiums. Any insurance premiums that you pay for any policies that cover medical care would be deductible. Medicare B premiums that are shown on the form SSA 1099 or on the form RRB for the railroad are deductible, and as are payments to the voluntary prescription drug insurance program, Medicare D. So you'll see those on your form SSA 1099, and in the event that you're using any type of sophisticated tax software, when you enter that amount, it will automatically populate into the medical expenses worksheet that is behind the Schedule A. When I say behind the Schedule A, I don't literally mean it's behind. I mean that worksheet feeds into the Schedule A. Weight loss programs. Weight loss programs would be considered a deductible medical expense. Any unreimbursed amounts that you pay for participating in a weight loss program that's a specific, that has been just prescribed as a treatment for a specific disease, which would include obesity, and that has been diagnosed by a physician, those would be deductible. What's not deductible is the cost of purchasing diet food. So any diet food items that would be included in those programs would not be deductible. Weight loss programs to improve your general health or appearance would not be deductible as well. So if you have a diagnosis for obesity from your doctor, you would be able to use the amounts paid for the supportive programs as a medical deduction, but not the actual food products. Stop smoking programs. What is a deductible is any amounts that you pay to a program to stop smoking. What's not deductible would be amounts that you pay for drugs that do not require a prescription. So any of the nicotine patches or gum, if there's not a prescription tied to it, you cannot use those in your medical deductions. If there were a prescription tied to it, then you would be able to. Any taxes that you pay. In order for a tax to be deductible, the tax must be imposed on you and must be paid by you during the tax year. So we do have individuals that come in and they actually have multiple back years of personal property taxes, and they pay them all off in a given tax year. Let's say that they paid 12, 13, and 14 all in 14. It would actually be deductible for 14. You would not go back to 12 and apply the amount there. So it's deductible in the year that you pay it, and it must be something that is owed to you. If you are a good friend, family member, etc., and you pay somebody's personal property taxes on their behalf, then you may not take it off on their taxes. Also, they may not take it off on their taxes because they did not actually pay the bill. So some of the deductible taxes that we look at are state and local income tax, general sales tax, any real estate taxes, personal property taxes, as well as foreign income taxes. You can elect to deduct either your state and local income taxes or general sales taxes, but not both. So your general sales taxes would be the actual local and general sales tax that you paid, or the optional sales tax from a table that's used to determine what would be an average local and sales tax based on your income and the state that you live in. So state and local income taxes would be the taxes that were withheld from your salary, any estimated payments that you made, as well as any balance due that you paid for an earlier year. All of those would be included in your state and local income taxes. So here we have Joanna, and she's single and lives in Mobile, Alabama. Her AGI for 2014 is $39,623. She did not purchase any major purchases like a motor vehicle or boat or an aircraft, and or any significant home building materials. And she doesn't have receipts to use the actual method. So she wants to see what her sales tax deduction would be. In Joanna's state and using the local sales tax deduction worksheet, you would see as follows. So here, optional state sales tax tables for Alabama. Her income falls between $30,000 and $400,000, and she's single, so you can see that her exemption would be 1, and so that amount would be $384. So using the actual sales tax deduction worksheet, you see the $384 on line 1, and you can see they're asking, did you live in and their specified states? And the answer is no, so we're going to enter 0. And did your locality impose a local general sales tax? Again, the answer is no, so we have nothing additional to add there. So moving on down, in this instance, there's nothing additional to add to the $384, and so Joanna's optional amount for a direct sales tax to be used on her Schedule A would be $384. Taxes and fees that would not be included, anything that's more of a license. So for example, a driver's license, hunting license, pet license, any water, sewers, or utility taxes, any taxes on alcoholic beverages, cigarettes or tobacco, taxes on gasoline, diesel, and other motor fuels, specifically if they are used in a non-business vehicle. Utility taxes such as your telephone, gas, cable, electric, etc. Any fines or penalties associated with the taxes that would be eligible to be used, any fines or penalties would not be added to that amount, as well as any federal taxes such as your income tax or your Social Security and Medicare. Those are not allowable taxes for you to deduct on your Schedule A. Here's a table straight out of the publication 17 that talks about the type of the tax and whether you can deduct it or whether you cannot deduct it. Any interest that you paid, you can deduct your home mortgage interest only if your mortgage is a secured debt. A secured debt is one in which you sign an instrument such as a mortgage or deed of trust that, number one, it makes your ownership in a qualified home security for payment of the debt. So they can actually foreclose on your home if it's not repaid. Second, it provides, in the case of a default, that your home could satisfy the debt. And third, it's recorded or is otherwise perfected under a state or local law that applies. So what this is saying is that you cannot use deduct interest that is not secured by your home. So if you have a credit card, even if you make purchases on that credit card that are associated with the house, you put in a new garage door or something like that, you would not be able to subtract that interest from your deduction, included as an itemized deduction. So you must report the interest that you paid on lines 10 through 14 of the Schedule A, and home mortgage interest and investment interests are deductible if they follow certain rules apply. So home mortgage interest, it's typically reported to you on a Form 1098. You'll see the amount that is being identified as mortgage interest that's being paid. If you do not receive a Form 1098, you can still report the mortgage. In that instance, you would report it on line 11 instead of line 10, and you would more than likely be asked for additional supplemental information. This is a table. It's table 8.3, part of chapter 8 in the publication 17, and this will go through specifics as to whether or not your mortgage interest would be fully deductible. The key thing here is it has to be secured by your home, and the money had to have actually been borrowed in association with your home. So if you took out a home equity line and you use that home equity line of credit to purchase a car, then you would not be eligible to use the interest paid for that equity line as a deductible interest item on your tax return. Points that are paid by the seller are usually deductible by the buyer. Points that are paid to refinance your mortgage are generally not deductible in full in the year that you pay them. However, there is a set of circumstances that would allow you to deduct them fully in the year that you pay them. In that instance, you're going to deduct things that are paid not as prepaid interest, in which case you would deduct the portion of the point that's relevant to that year. Any points that are reported on Form 1098 on line 10 would be reported on line 10. If they're not reported on line 10 on Form 1098, you could enter them in line 12. Mortgage insurance premiums, any mortgage insurance premiums that are based on contracts, whether it's a refinance or an initial purchase that took place after January 1st of 2007, generally can be deductible. Interest that you pay on investment interest. You can deduct your investment interest to the extent that you have investment income. If you have excess investment interest, you can carry it over to future years. So for example, if you had paid investment interest to the tune of $5,000, but your investment income was only $1,500, you would write off the $1,500 in the year that you actually paid it and carry over the remaining $3,500 to be used in future years as that investment continues to pay off. And there's a Form 4952 that will determine the exact amount of deductible investment interest. Gifts to charity. You can report charitable contributions on lines 16 through 18 of the Schedule A, and here are the qualified organizations as well as organizations that do not qualify. So while you may have made a charitable payment to an individual, and we see a lot of fundraisers where people are asking for assistance, if it is not to a qualified organization, then you would not be able to deduct it on your federal income tax. Here's some deductible items. Any money that's given to qualified organization, dues, fees, and assessments paid to qualified organizations above the value of the benefits received. So for example, if you pay $50 to a qualified organization and in return for that donation, they send you a CD or a DVD that's worth $5, then the amount that you can actually write off would be $45, not the full $50. You can deduct contributions of used clothing and furniture and any cost or upkeeps of uniforms. Unreimbursed transportation expenses and the part of the contribution above the fair market value. So in the event that you donated something that you had paid more, you actually paid $5,000 for it, you donated it, and at that point in time the fair market value was less than that, you may be able to deduct it depending on the item, if it's a collectible, and it would retain its value for certain circumstances, or it could be land or other types of tangible property. Non-deductible items would include any costs of raffle tickets, bingo, lottery tickets that you make to a charitable donation where you are actually participating in a chance to win, any tuition that's paid to a qualified institution, the value of your time or service. This is one that I have people question me all the time, and this is what I tell them. In the event that you donate $5,000 worth of your time, you would only be able to write off the $5,000 to the extent that they paid you $5,000 and you included it as income, and then you turned around and paid it back to them as a donation. If you do that, it's still a net of zero because you would have to include it on the income as well as on the deduction, and that is how you should be thinking about any valuation of time that you contribute to a charitable organization. Any blood that's donated to a blood bank where the Red Cross is specifically excluded from being deductible. Car depreciation, insurance, general repairs or maintenance on a charitable donation, or as it relates to mileage. You can use standard mileage in support of a charity, but you cannot use actual expenses. Direct contributions to an individual, any sickness or burial expenses for members from a fraternal society, even if you paid them, that is not a deductible charitable expense. The part of the contribution that personally benefits you, and back to the example of where you received a DVD or CD in exchange for your donation. The fair market value of property that you give to a charitable organization can be deducted, and it's determined on the date of the gift. If the property has increased in value during the time that you owned it, you would deduct your basis in it or the property's fair market value on the date that you gift it. If the property has decreased in value during the time that you've owned it, you usually deduct its fair market value, and this would be the case for used clothing, furniture, books and appliances, etc. Clothing or household items that are donated must be in good use condition. An item not in good use condition can be deducted if it is more than $500 and a qualified appraisal is attached. So in that instance, let's say that you have a vehicle that is no longer functioning, and it's definitely not in good use condition. If you have an appraisal and that's attached to your tax return, you can donate, you can include the amount that it was valued at as a charitable donation. Used vehicle, boats, and airplanes that have a claimed value of $500 or more must have a written acknowledgement from the organization. The deduction would be the smaller the fair market value of the date of the contributions or the gross proceeds received from the sale. So if you donated your car, for example, and you had a fair market value according to Kelley Blue Book of $1,500, $2,000, but the charity that you donated it to sold it at auction and only received $400 for it, then the amount that you would receive in that written statement would only be $400, and that would be the only amount that you would be eligible to write off on your deductible, your itemized deductions. The deduction is not limited if the organization gives or sells the vehicle to a needy individual. So in the event that that same $1,500 car, rather than selling it at auction, they actually turned it right over to an individual that was in need of it and it was used without any significant improvements, then you would be able to deduct the full $1,500. We do use the used car guide to assist us in determining the fair market value of vehicles on the dates that they are transferred. In the event that your non-cash items are over $500 a year, then you would need to complete the Form 8283. And this does ask for significant details, including descriptions of the items that were donated, in addition to the amount, how those items were acquired originally. Was this from a gift? Was it an inheritance, or was it originally purchased? And what the value was at the time that it came into your possession. So if you go over $500, there is an extensive questionnaire that must be completed. The amount of deductions may be limited depending on your AGI and the amount and type of property that's being used, as well as the type of charitable organizations. In the event that you are limited, you can carry over the contributions that exceed the amount and continue to use it in the next 5 years until that donation amount has been fully used. So if it's under $250, you can use as your record keeping just a canceled check or receipt or anything like that. If it's more than $250, it must be in the form of a written acknowledgement. In many instances, churches will provide you with a year-end statement totaling your contributions. That's what you would need to do if the total amount that you contributed to that particular organization is over $250. There is a place on the Schedule A for gambling losses. You can input the gambling loss up to the amount of gambling winnings, and any that repayments of more than $3,000 under a claim of right would also be able to be listed here on row 28. So in this case, Joey won $1,000 in the state lottery. He also won $50 playing bingo, so for total winnings of $1,050. During that year, he spent $3,000 on lottery tickets and $10 on bingo cards. Can you deduct any of the gambling losses if he itemized his deductions, and if so, how much? So the first answer is no, yes, $3,000, yes, $310, yes, $1,050. And it's going to be, he can deduct $1,050 because that's the amount that he is claiming as winnings. There can be a limit on your itemized deductions in the event that your adjusted gross income exceeds the following: $305,050 if you're married filing a joint return or a qualifying widower, $279,650 if you're head of household, $254,200 if you're single, or $152,525 if you're married filing separately. The items that would be subject to the limit would include your taxes paid, interest paid, gift to charity, job expenses, as well as your miscellaneous deductions. The deductions that would not be subject to the limit would include your medical and dental, any investment interest expense, casualty and theft losses, as well as gambling losses. Those would not be subject to the reductions based on your income. Well, thank you very much for your time and attention. As always, if you have any questions, please feel free to send us an email, as well as the fact that there's additional information that's available on our website. And good luck with the tax season.